A 68-year-old widow in Ohio just received a letter from the IRS demanding $12,000 in back taxes and penalties. She didn't fail to file her taxes. She didn't hide income. She didn't do anything illegal. She simply had the wrong type of bank account. Nobody told her the rules had changed. Right now, in 2026, the IRS has ramped up monitoring on 3 specific types of bank accounts that millions of seniors use every single day. And if you have one of these accounts, you could be facing penalties, audits, or massive tax bills, even if you've done nothing wrong. The IRS won't send you a warning. Your bank won't call you. And by the time you find out there's a problem, it could cost you thousands of dollars. Today, I'm going to show you exactly which 3 accounts are being watched, why the IRS is targeting them, and most importantly, what you need to do right now to protect yourself. This isn't theory. This isn't speculation. These are real IRS enforcement priorities for 2026, and they're hitting retirees the hardest. Stay with me, because what I'm about to share could save you thousands of dollars and years of stress dealing with the IRS. My name is Robert Hayes, and for more than 22 years, I've been helping seniors navigate the minefield of retirement taxes, Social Security rules, and government regulations that seem designed to confuse people. I've seen firsthand how simple banking mistakes can turn into financial disasters for retirees who've done everything right their entire lives. And I've watched as the IRS has quietly shifted its focus toward monitoring everyday bank accounts that millions of seniors rely on. The information I'm sharing today comes directly from IRS enforcement bulletins, banking compliance requirements, and conversations with tax professionals who work with retirees every single day. This is information you need to know. And it's information that almost nobody is explaining in plain English. So let's dive in. Bank account number 1, high balance accounts. The first bank account the IRS is watching closely in 2026 is any checking or savings account with a balance over $10,000 that shows frequent large deposits or withdrawals. Now, let me be clear. There's nothing illegal about having money in your bank account. You've earned that money, you've saved it, it's yours. But here's what's happening. The IRS has increased its use of automated systems that flag accounts when certain patterns appear. And one of the biggest red flags is when a senior's bank account shows large, irregular deposits, especially if those deposits don't match up with what the IRS expects to see on your tax return. Let me give you an example. You sell your car for $8,000 and deposit the cash into your checking account. 2 months later, you withdraw $7,000 to help your daughter with a down payment on a house. Then you deposit $6,000 from selling some old jewelry. To you, these are normal life transactions. You're not doing anything wrong. But to an IRS computer system, this looks like potential unreported income. It looks like you might be running a business and not reporting it, or hiding income from rental properties, or failing to report investment gains. And once that flag goes up, you could receive what's called a CP 2000 notice, which is the IRS saying, "We think you didn't report all your income and you owe us money." Now you're on the defensive. You have to prove that car sale wasn't taxable income. You have to document where that jewelry came from. You have to explain every single transaction. This could cost you thousands in accountant fees, penalties if you can't prove everything, and months of stress. Why most seniors is this. Most retirees have no idea the IRS is monitoring their bank accounts at this level. You assume that as long as you report your 1099s and your Social Security income, you're fine. But the IRS doesn't just look at what you report anymore. They're cross-checking it against banking data. And if something doesn't match up, you're getting a letter. Who this affects most? This hits hardest if you receive irregular lump sums, inheritance, insurance payouts, selling property or vehicles, help adult children financially with large transfers, have multiple income sources beyond Social Security, keep large cash reserves in checking or savings. What you need to do right now. First, keep detailed records of any large deposit or withdrawal over $1,000. Write down where the money came from or where it went. Keep receipts, keep sale documents, keep everything. Second, if you're receiving money that isn't taxable, like a loan repayment from a family member or proceeds from selling personal property at a loss, document it immediately. Don't wait until the IRS asks. Third, consider working with a tax professional to file what's called a Form 8275 if you have any large, unusual transactions. This form basically tells the IRS, yes, I know this looks unusual, here's why it's not taxable income. The consequence of ignoring this. If you do nothing and the IRS flags your account, you could face a CP 2000 notice demanding thousands in back taxes, penalties of 20% or more on top of what they claim you owe, months of back and forth correspondence, potential audit if you can't immediately prove your case. The widow I mentioned at the beginning, she received an $8,000 insurance payout when her husband died, and she deposited it in her checking account. The IRS flagged it as unreported income. It took her 8 months and $4,000 in accountant fees to prove that life insurance death benefits aren't taxable. 8 months of stress, $4,000. All because nobody told her to document it. Now, that first account type affects a lot of seniors, but the second one I'm about to share is even more common, and it's causing massive problems for retirees who are just trying to help their kids. Stay with me, because this next one could save you from a $16,000 mistake. Bank account number 2, joint accounts with adult children. The second bank account the IRS is watching in 2026 is any joint account you share with an adult child. Millions of seniors have added their son or daughter to their checking or savings account. Sometimes it's for convenience, so your child can help pay your bills if you're sick. Sometimes it's for estate planning to avoid probate. Sometimes it's just peace of mind. It seems harmless, it seems smart, and your bank probably encouraged you to do it. But here's the trap that's catching thousands of retirees right now. When you add your adult child to your bank account as a joint owner, the IRS may treat that as a taxable gift. And if the account balance is over a certain amount, you could owe gift taxes. Or at minimum, you're supposed to file a gift tax return. Even worse, when you die, the IRS assumes that 100% of the money in that joint account belongs to your child, unless you can prove otherwise. And that means your estate could face massive tax bills, or your other children could lose their inheritance. Let me break this down. Let's say you have $80,000 in your savings account, and you add your daughter as a joint owner so she can help you with banking if you get sick. The day you add her name to that account, the IRS could consider that a gift of $40,000 to your daughter, half the account balance. Now, you might think, but I didn't give her $40,000. That's still my money. She's just on the account for emergencies. Doesn't matter. The IRS sees it differently. In 2026, the annual gift tax exclusion is $19,000 per person. If you gift more than that to any individual, you're required to file Form 709, the gift tax return. If you don't file it, you could face penalties, and when you pass away, your estate could be hit with back taxes and interest. But it gets worse. Let's say you pass away, and you have $80,000 in that joint account with your daughter. You have 2 other children, and your will says everything gets split 3 ways. The IRS says that entire $80,000 belongs to your daughter now because she was the joint owner. Your other 2 children might get nothing from that account, even though that wasn't your intention. Now your kids are fighting. Your estate is in chaos, and attorneys are eating up thousands of dollars of your hard-earned money. I can see why most seniors miss this. Nobody tells you this when you open a joint account. The bank employee just hands you a form to sign. Your child signs too. It takes 5 minutes. No one mentions gift taxes. No one mentions estate complications. No one warns you that you might need to file paperwork with the IRS. And most seniors assume that if the bank allows it, it must be fine. Who this affects most. This is a huge problem if you have adult children on your checking or savings account, have accounts with balances over $19,000, have multiple children, but only one is on the account, are trying to avoid probate by using joint accounts, haven't updated your estate plan in years. What you need to do right now. First, if you've added a child to a bank account in the past few years, talk to a tax professional or estate attorney immediately. You may need to file late gift tax returns to avoid penalties. Second, consider removing your child as a joint owner and instead setting up a power of attorney for banking or a convenience signer arrangement. Many banks offer this. It lets your child access the account to help you, but they don't legally own the money. That means no gift tax issues. Third, if you're using joint accounts for estate planning, stop. There are much better ways to avoid probate that don't create tax problems. Talk to an estate attorney about payable on death accounts or setting up a simple revocable trust. The consequence of ignoring this. If you do nothing, here's what could happen. When you die, the IR could claim your estate owes gift taxes going back years. Penalties for not filing gift tax returns can be thousands of dollars. Your children could end up in legal battles over who gets what. You could accidentally disinherit children you intended to provide for. This is one of the most common mistakes I see, and it's completely avoidable if you know what to do. Okay, those first 2 account types are serious problems, but the third one I'm about to reveal is the one that can actually trigger a criminal investigation. I'm not exaggerating. Seniors are being investigated right now because of this banking mistake, and they had no idea they were breaking the law. Stay with me. This is the most important one. Bank account number 3. Multiple small accounts to avoid reporting. The third bank account situation the IRS is aggressively watching in 2026 is when a senior has multiple bank accounts at different banks and is moving money between them in ways that look like they're trying to avoid reporting requirements. This is where things get serious because this can trigger accusations of structuring, which is a federal crime. Now, before you panic, let me explain what this means and why innocent seniors are getting caught up in this. There's a federal law called the Bank Secrecy Act. It requires banks to report any cash transaction over $10,000 to the government. The bank files what's called a current. The purpose is to catch money laundering, drug dealers, tax evaders, criminals. But here's the problem. Some seniors, often on the advice of a friend or something they read online, start intentionally keeping their cash deposits or withdrawals under $10,000 to avoid triggering that report. Maybe you sell something for $15,000 cash and you think, I don't want to deal with government paperwork, so I'll deposit $7,000 today and $8,000 next week. Or maybe you need $20,000 in cash, but you withdraw $9,000 one day and $11,000 a few days later because you heard the bank report's large withdrawals. Or maybe you have $40,000 you want to spread across different banks because you're worried about FDIC insurance limits, so you open accounts at 3 different banks and deposit $9,500 in each one on the same day. To you, this seems smart. You're just being careful. You're managing your money responsibly. But to the IRS and the banks, this looks like structuring, deliberately breaking up transactions to avoid reporting requirements. And structuring is a crime. It doesn't matter if the money is legal. It doesn't matter if you've already paid taxes on it. If the government believes you're intentionally avoiding reporting, you could face asset seizure. They can freeze or take your accounts. Criminal charges. Fines up to $250,000 prison time. In extreme cases, I know that sounds insane. You're a law-abiding senior citizen. You're not a criminal, but I've seen this happen, and it's terrifying. Why most seniors? Miss this? Most retirees have no idea that structuring is illegal. You think you're just being private. You're not trying to break the law. You're just trying to avoid hassle and paperwork. And honestly, some seniors were taught by their parents' generation to never let the government know your business. So they think avoiding reporting is just good common sense. But the law sees it very differently. Who this affects most? You're at risk if you regularly deal in cash and make deposits under $10,000, withdrew money from retirement accounts in large lump sums and spread it across multiple banks, sold property or assets for cash, and deliberately broke up the deposits, were advised by a friend or relative to keep transactions under $10,000, have opened multiple bank accounts at different institutions in a short time period. What you need to do right now. First, stop breaking up transactions to avoid the $10,000 reporting threshold. Just let the bank file the report. There's nothing wrong with the report being filed if you're not doing anything illegal. The report is not the same as an investigation. Second, if you have legitimate reasons for having multiple bank accounts or moving large amounts of money, document everything. Keep records of why you're doing what you're doing. Third, if you think you may have already made this mistake, if you've been deliberately structuring transactions, talk to a tax attorney immediately. You may be able to file a voluntary disclosure before the IRS comes knocking. The consequence of ignoring this. This is the one that can destroy you financially and legally. If the IRS or FinCEN, Financial Crimes Enforcement Network, believes you've been structuring transactions, they can seize your bank accounts without warning, freeze your assets while they investigate, charge you with federal crimes, force you to hire expensive attorneys to defend yourself. Even if you're eventually cleared, you could lose tens of thousands of dollars in legal fees and months or years of your life dealing with the case. Now, I know this all sounds overwhelming. You might be thinking, how am I supposed to know all these rules? Why doesn't anyone tell us this? You're right. Nobody tells you. The banks don't warn you. The IRS doesn't send out helpful guides. You're just expected to know. That's exactly why I created this video. But before I give you the action plan to protect yourself, let me share a real story that shows why this matters so much. Last year, I got a call from a man named Robert. He was 71 years old, retired from the Postal Service, and he was in tears. Robert had received a letter from the IRS claiming he owed $28,000 in taxes and penalties. He couldn't understand why. He filed his taxes every year. He reported his pension and his Social Security. He'd never had a problem with the IRS in his life. Here's what happened. 3 years earlier, Robert's wife had passed away. He received a $50,000 life insurance death benefit. He also sold their second car for $12,000. And his wife had a small retirement account with $18,000 that transferred to him. All legal, all documented, most of it not taxable. But Robert deposited all this money into his checking account over the course of a few months. The IRS computer saw unusual activity, deposits that were much larger than his normal pension and Social Security. The IRS sent him a CP2000 notice saying, "We see you deposited $80,000 more than you reported on your tax return. You owe taxes on that money plus penalties. Robert panicked. He didn't keep great records. He threw away most of the paperwork because he didn't think he needed it. Life insurance isn't taxable, so why would he need to keep the forms? Now he had to prove everything. He had to track down documents from the life insurance company. He had to find the title transfer from selling the car. He had to get statements from his wife's retirement account administrator. It took him 11 months, $6,000 in accountant fees, and countless hours of stress and anxiety. He finally got the IRS to drop most of the claim, but he still ended up paying $30,200 in penalties because he couldn't document everything perfectly. $30,200 lost, $6,000 in accountant fees, 11 months of stress, all because nobody told him to keep records of large deposits. Robert wasn't doing anything wrong. He was just living his life, grieving his wife, and trying to manage their finances. But the system treated him like a criminal until he could prove otherwise. That's what's happening to seniors all across this country right now. And it's only getting worse as the IRS increases its monitoring. So what do? This week, not next month, not someday, this week, I want you to do these 4 things. Action. Step 1. Document everything. Starting today, keep a simple notebook by your desk. Every time you make a deposit or withdrawal over $1,000, write down the date, the amount, where it came from or where it went, any paperwork or receipts. This takes 30 seconds per transaction, and it could save you thousands of dollars in accountant fees later. Action. Step 2. Review your joint accounts. If you have an adult child on any of your bank accounts as a joint owner, call your bank this week and ask, is this person a joint owner, or are they just an authorized signer? If they're a joint owner and the account has more than $19,000, call a tax professional and ask if you need to file a gift tax return. Then ask your bank about changing the account to a power of attorney or authorized signer arrangement instead. Action step 3, stop structuring if you've been doing it. If you've been deliberately keeping cash transactions under $10,000 to avoid reporting, stop immediately. From now on, if you need to deposit or withdraw more than $10,000 in cash, just do it. Let the bank file the report. You're not doing anything wrong, and the report is not an audit. If you think you've already made this mistake multiple times, talk to a tax attorney before the IRS contacts you. Action. Step 4. Organize your tax records. Go through your files and make sure you have documentation for any life insurance payouts you received, any large gifts from family members, any inheritance or estate distributions, any property or vehicle sales, any large withdrawals from retirement accounts. If you can't find the paperwork, contact the insurance company, bank, or whoever sent you the money and get copies now while it's easy. Don't wait until the IRS asks. Look, I know this video probably scared you a little bit. That wasn't my intention. My intention is to prepare you. The truth is, these IRS monitoring systems aren't going away. They're getting more sophisticated every year. And seniors, who often have irregular income from inheritances, insurance, retirement accounts, and Social Security, are the ones getting caught in the crosshairs. You're not doing anything wrong. You're just living your life and managing your money the best you know how. But the system doesn't care about your intentions. It only cares about patterns and paperwork. So protect yourself. Document everything. Keep records, ask questions, and don't assume that just because the bank lets you do something, it's okay with the IRS. Before I go, I need to mention I'm not a tax attorney or CPA. This video is for educational purposes only. It's not specific legal or tax advice for your situation. Everyone's circumstances are different, and you should talk to a qualified professional about your specific accounts and tax situation. But the general information I've shared today applies to millions of seniors, and it's information you need to know. If this video helped you, do me a favor. Share it with another senior who needs to hear this. Send it to your spouse, your friends, your neighbors. This is information that could save someone thousands of dollars. And if you haven't subscribed to this channel yet, click that subscribe button right now. I post new videos every week about retirement taxes, Social Security, Medicare, banking rules, and all the financial issues that affect seniors. Information the government won't tell you, but you need to know.